Ron, there's so many things to talk about. State Street, plays such an important role in financial markets, but here's where I want to begin, because there are a few more important things to financial markets right now than the Fed liquidity programs. State Street is playing a key role in at least three of those programs: money markets, commercial paper, and corporate credit. What can you tell me about the way those programs are working so far?
Well, listen, Eric, what these programs are emblematic of is how effectively the Fed and Treasury and policymakers in general have operated here. And what everybody recognized quite early on was that you have a public health crisis that has caused a rapid shutdown in economic activity that was quickly transferring to the financial markets. So these programs that were put in place by the Fed were designed to make sure that liquidity was brought to markets and that transacting would occur, because what everybody quickly realized is that when you're shutting down economic activity, there was going to be big needs for credit. At the same time, when investors were going to be moving money to cash and taking risk off. And what you don't want to have is lots of money being idle and lots of needs and not being able to meet those needs through the capital market. So those programs and several others that the Fed had brought up were designed to make sure that markets continue to transact. That, coupled with the liquidity that's poured into the system, has really enabled markets to function pretty well. And it was important in March, and will be very important as we start to restart economic activity.
Ron, are you surprised at how little lending the first few of those facilities has actually had to do? I'm thinking, for example, of the money market facility and the primary dealer credit facility, and there also isn't much going on in the commercial paper funding facility. Not yet, anyway.
You know, Eric, this is just a reminder, though, that with all the machines that we have and all the computers that we have, there's human beings behind this. And I believe there's been so relatively little transacting in that because people know it's there. They're willing to transact, and price discovery was able to happen because investors knew that if they needed to sell, there'd be a market. If they had concerns that there weren't a market because of some gap in buying and selling, then you'd have a real crisis. So this really comes back to, it's a little bit, if I know I've got the insurance there, that doesn't mean I need to draw on the insurance. So in effect, what the policymakers have done have put insurance in place, and markets are now operating without the insurance.
One more question about this. I've heard there's some confusion about which kinds of companies are eligible to borrow from the Fed under the corporate credit facilities. Are you up to speed on that?
There is some confusion, and part of it is, again, these programs have been stood up quite quickly. The Fed's been quite good about, taking feedback to the extent to which there's an unfulfilled need. They've been pretty quick at pivoting. So, for example, during the money market liquidity facility, there was actually a relatively narrow set of securities that qualified. Literally overnight, the Fed would take feedback and change that and open it up. So I know there is some confusion. I think that will get resolved.
Gary Cohn, former director of the National Economic Council, told me today one of the obvious lessons of this crisis, Ron, is that because of Dodd-Frank, which clearly made America's banks safer, those same banks can't provide enough credit and liquidity when it's most needed, i.e. now. What do you think we should do? Do you agree that maybe the rules should be loosened at times like these, or would that just open a Pandora's box?
Well, you have to remember the last financial crisis and the problem that we were trying to solve then, which was really banks that were undercapitalized in some cases and not having the ability to, not having the capital strength to do what they needed to do, and sense that some of these banks were too excessively leveraged. That problem is solved, but you solve that problem by putting in place heightened capital requirements, heightened liquidity requirements, and that just means that there's less money to lend. So this is always a balancing act. I don't think at this point one can conclude that there isn't enough money available to lend. I mean, again, think about the crisis that we're trying to solve for. This is shutting down not just the U.S. economy, but the world economy, recognizing that for a period of time, economic activity will be at a fraction of what it normally is. That's a demand on credit that almost doesn't matter to me what the capital rules are. Banks by themselves couldn't resolve. And that's where you have central banks and governments coming in to provide a backstop. So I think that sure, there's going to be a conversation about do we have the balance right? But one thing that we can be confident in is banks now are under stress, but seem to be operating fine, right? That extra capital has enabled them to actually not be stressed in this environment.
State Street has an enormous operation in China, some 3,000 people. So you knew what a stay-at-home order was all about long before we ever had to deal with it here in New York State, Massachusetts, the rest of the United States of America. What lessons, Ron, has State Street learned from China that we ought to keep in mind over the next few months here in America?
Well, Eric, as you note, we do have a large operation in China, and it does a lot of back office operations for our clients throughout the Asia Pacific region, and provides mutual fund accounting and things like that. And it was in mid-January that we learned that we needed to start shutting down the operation and working from home. That was part of our business continuity plan. Although we never imagined that we'd be sending everybody home in basically 4 business days. So we learned how to do that and recognized that one thing we needed to do was to prepare the rest of the world for that, particularly other parts of the developing world that we operate in. We're now at the stage where we're bringing people back, and we're taking lessons from there. I mean, one thing, you've got to reconfigure facilities. Testing is part of what we're doing. In China now, masks as people are in the building, separating them so people aren't on top of each other. So I think this will be very much how we and others operate in the United States when we start bringing people back into offices.
Do you think, Ron, very quickly, as James Gorman from Morgan Stanley told me, one of the end results of this is you're going to need less real estate?
I think there'll be some profound lessons out of that, and that's one of them. I think that that work from home won't be just something that's for the convenience of a worker or for a disaster situation. I think that we'll find that it's, first of all, we've all learned that there's more we can do from home than we realized. And again, we've got to be sensitive to our workers and make sure that we're supporting them in setting up their own facilities at home. But I also think it has implications.
I'm sorry to interrupt.
And where they work.
I would love to keep up the conversation, but we've run out of time. Let me take this opportunity, Ron, to thank you. Ron Hanley is the Chairman and Chief Executive Officer of State Street, joining us from Boston.